Navigating retirement means making tough financial decisions, and one question that consistently paralyzes retirees is whether to keep or cancel their life insurance policy. You have paid into this policy for decades, treating it as a non-negotiable safety net, but as your income changes and your fixed expenses rise, those monthly premiums can start to feel like an unnecessary drain on your nest egg. The fear of making the wrong choice is real. If you cancel too soon, you might leave a surviving spouse with unpaid debts or a sudden drop in income. If you keep it, you could be throwing away thousands of dollars every year that could have funded your lifestyle, medical care, or travel. To make the right choice, you must go back to the fundamental purpose of life insurance, replacing lost income during your working years so your dependents are not left financially vulnerable. When you enter retirement, that fundamental equation shifts dramatically. You are no longer working to build wealth, you are living off the assets you have already accumulated. If your mortgage is paid off, your children are financially independent, and your retirement portfolio can fully support both you and your spouse for the rest of your lives, you are what financial planners call self-insured. In this situation, continuing to pay for a life insurance policy is often redundant. You are paying money to protect an income stream that no longer exists. However, assuming everyone should cancel their insurance at age 65 is a dangerous oversight. There are specific, high-stakes scenarios where keeping your coverage is critical to protecting your family. The first scenario involves pension income. If you chose a single life pension payout option to secure a higher monthly check while you are alive, that pension income dies with you. If your surviving spouse relies on that check to cover daily living expenses, canceling your life insurance leaves them facing a severe financial drop. In this case, keeping a policy acts as a replacement for that lost pension. The second major scenario is outstanding, non-negotiable debt. If you carried a mortgage into retirement, or if you hold joint debts, co-signed loans, or significant medical bills, those obligations do not disappear when you pass away. Without a life insurance payout, your spouse or heirs may be forced to sell assets, downsize abruptly, or drain their own savings to clear the remaining balance. The third critical reason to retain coverage is estate liquidity and legacy planning. If your wealth is tied up in illiquid assets, such as real estate, family businesses, or land, dying without cash reserves can trigger massive financial friction. Estate taxes, legal administration, and executor fees must be settled, often quickly. A life insurance death benefit provides immediate, tax-free cash to handle these expenses without forcing your heirs into a distressed sale of your physical assets. If you examine your situation and realize you no longer need the policy, do not simply call your insurer and demand an immediate cancellation. Canceling outright can result in surrender fees, unexpected tax obligations on accumulated cash values, or a complete loss of the capital you invested. Before walking away, explore middle ground alternatives. If you hold a permanent policy with cash value, you may be able to execute a reduced paid-up insurance option. This allows you to stop paying premiums entirely while converting your existing cash value into a smaller, permanent death benefit that remains active for life. Another option for permanent policies is a life settlement, where you sell your policy to a third-party investor for an upfront cash payout that is higher than the cash surrender value, though lower than the death benefit. If you hold a term policy that is growing too expensive, you can ask your provider to lower the total coverage amount, which proportionately lowers your monthly premium while maintaining a smaller safety net. Your actionable takeaway today is to perform a simple math audit on your policy. Write down the total annual cost of your premiums and compare it directly against your surviving spouse's projected annual shortfall if you were to pass away tomorrow. If your retirement savings, Social Security, and investments cover that shortfall completely, your policy has served its purpose and it is time to exit strategically. If a gap exists, preserve or adjust the policy to cover that specific gap, and nothing more. Base this decision strictly on mathematical necessity rather than emotional attachment, ensuring your money serves your quality of life today while keeping your loved ones secure tomorrow.